morning, everyone. Great to see you all. My name's Colin Hamilton. I do the commodity analysis for BMO, based in London. Cover all base metals, precious metals, critical minerals, as we call them these days, and indeed the bulk commodities. I'm going to talk today just about some of the thematics we're seeing, some of the things that are driving the things behind our markets that we're factoring into supply demand, some of the more structural changes we're seeing across commodity markets and how that might play in, of course, to mining equities as well. In terms of BMO, I hope many of you will know us. We are a large global investment bank, but really with a focus on metals and mining. We host our BMO conference in Miami every year, every February, and very well attended. In fact, record attendance at it this year, both from a corporate and investor standpoint. Just talk about some of the key themes first of all. But it's been a good start to the year actually for commodity prices in the main. And what's interesting for me, anytime I talk to people, so my job, I spend a lot of time focused on the China markets, because if I get the China markets right, then it helps a lot in terms of price forecasting and market intelligence. And anyone you speak to will tell you that China's going to be great. And bad data is backward looking. There's a lot of China confidence out there. And if you're in financial markets, if you're a macro asset allocator coming back to your desk early in the new year, well, what were you looking at? You're looking at a weakening dollar. You're looking at better China economic expectations. Your playbook there is you buy metals. And that's what we've seen. We've seen a lot of financial market money coming back into commodities as an asset class. And that has certainly helped in terms of the metals side. I have to say, I think China will get better, and I'll talk about that in the presentation. I do think that expectations are pretty high. And I said there, China recovery is priced to perfection. I do think that there's a view out there that you just flip a switch after Lunar New Year and China's back up and running at full pelt. That will not be the case. There's a bit of scope for data disappointment over the next couple of months, but I do think you'll see a better Chinese economy as we head through the year. Now, in terms of it, it's not going to be a great year for industrial demand. Inflation's doing its job, as I said there. Inflation hurts demand. That's what it's there for. And we have been revising down demand estimates for much of the past 6 months. I would say that's stopped, and European expectations are maybe too negative. And as power prices have come down in Europe, well, actually, we're not revising those down anymore. I also, and I will talk about it, I do think we've seen a pretty active destock at the end of last year, which is why we're seeing some slightly better physical numbers now as the restock comes through. What hasn't changed in these markets is supply continues to disappoint. And there's going to be a lot of focus at this conference, at many mining conferences this year, over the lack of investment that's still going into many commodities and how that might have to change, and how, quite honestly, maybe governments have to get more involved in that process. And I'm a big believer, with everything that's gone on in the past year, and I remember presenting it up here in May last year, that the fuel to materials transition is being accelerated by everything that's going on. Energy independence is now defence spending in many cases for governments, and it will take place no matter what, who the government is in many of these democracies. Now, as part of that, security of raw material supplies is becoming increasingly critical. And over and above that, we are seeing supply chain segmentation coming through. We're seeing a lot of geopolitical lines drawn that are going to affect many of these markets. So I'll talk about that. And if there's one thing I want everyone to take away from presentation today, it's the change in dynamics across commodity markets. A flippant statement here, but as a world, we got used to things just being there for 20 years. If we wanted something from the shop, it would be there. If you're a utility, you want a fuel, easy, get it. If you're a manufacturer, you want metals, they were going to be there. That's no longer the case, and particularly not of the type that you may want. So therefore, we are going to see a lot more concern about security of supply risk. As a purchasing manager, you have to layer that now into your strategy, and it does mean that there will be a risk premium in many cases, I would call it, basically a higher through-cycle commodity price in order to get that value chain integration. To come on to some of the charts, industrial production, I mentioned it before. If you look at that blue bar on the left-hand side, you can see that actually we're starting to dip into a little bit of an ex-China recession. this is what inflation does. Inflation hurts demand. And with the power situation we had in Europe, certainly towards the end of last year, we're seeing a big cut to industrial activity. US looking a little bit shaky. And then if you look at the right-hand side there, you look at global manufacturing PMIs. That's, I mean, a good coincident indicator, if you want, that you can get for metals. And you can see there, basically less than a third of the economies we track now are in manufacturing expansion. So it's not going to be a great year for industrial demand. You can see we do have China improving a little bit as the year goes on. And I suppose I mean, a lot of this comes down to your inflation expectations. My view is getting from 10% inflation to 5% inflation is easy. Getting from 5% inflation to 2.5%, which is where a lot of governments want it to be, is going to be harder. There's still going to be a few pressures there. So we will see relatively subdued industrial demand, but on the whole, a better China tends to outweigh that. If we look at the other side of the equation, I mean, a lot of the issues we've had in commodities in the through the pandemic and the post-pandemic era have been around supply issues. I mean, if you remember the challenges we had with container markets, with general logistics, well, the left-hand side there looks at the global supply chains pressure index. Now, it's still relatively elevated, and actually recently you've seen a bit of an uptick again. That is the COVID wave going through China. And that has affected movements of materials again. But on the whole, it's come down a lot from the peak. So again, a little bit less pressure coming through there. We are seeing materials start to flow again. And if you look at the right-hand side, I mean, that's maybe a more abrupt chart. You can look at that European gas price index. And you see where we got to, basically up 7-fold from the lows to the highs, or in fact almost 10-fold. Well, it's coming back down again. In fact, there's a growing view the gas prices may actually be flat to negative in Europe in Q3 because as the economy runs out of storage. So you're seeing some of those supply pressures starting to ease. That means we get back to a normal cycle. A lot of 2023 is going to be about normalization from the panic and the abrupt price moves we saw last year. Won't dwell on this, but generally for commodity markets, the exchange rate we look at a lot is the RMB because China's your marginal buyer and indeed marginal producer of a lot of the commodities we look at. And you can see there, I mean, if we had this depreciating RMB, generally bad for commodity prices from the middle of last year. And if you look at it, commodity prices peaked around April, May, and then fell. That's reversed pretty quickly recently. So again, that would be viewed as supportive of commodity prices. In terms of oil prices, that's more an input to the cost side, of course, for mining, and we have seen them, again, normalise, come back to levels that are elevated, but not ones that are getting scary, which is kind of where we were last year. Data's not great, and in terms of the near-term data, in fact, December's data was particularly bad, and I'll talk a little bit about it here. If there's a big worry there, for many of us, it is US housing. US housing had a very strong couple of years, but you can see there we're now looking at US housing starts down 20% year on year. That's important for the wealth effect to many cases in the US. So while Europe is maybe looking not as bad as we had feared, I would argue the US is concerning a little bit more. We have metals demand down anywhere between 0 and 5% in the US this year. Could be worse, so we're keeping an eye on that. That's something that we're going to have to think about. The China data is also particularly weak for December. Now, this is the function of an economy where you did open up very quickly and you had a big wave of infections and actually workforce attendance was way down and therefore things stopped flowing. So actually, one of the things I look at for copper demand is wire and cable fabricators operating rates. And if you look at the right-hand chart there, we're only at kind of, we're sub 70% in December, well below the 5-year trend. And I mean, the weakest data point ex a Lunar New Year in quite a while. So it's not like demand's been good, but China confidence is definitely improving. Now, this is a very important point, and I think it's one that's probably I'm surprised I don't get any more questions on it. The visible inventory cover in a lot of these markets is pretty low. So if you think of the world at the moment, there's a lot of worry that retailers, the Walmarts of the world, are totally overstocked. They've got way too much product. They're going to have to sell it down into the market. At the other end of the value chain, at the raw material side, we're really short of inventory cover. And we saw here, I mean, if we tin's a bit of an unusual situation, but if we look at all the others, we did see, I mean, in the main, a drop in exchange inventories over the course of last year. I mean, in the case of zinc there, I mean, an 80% drop. I mean, my favourite stat that I like to keep quoting at the moment is you can buy up all the available zinc in the world with 6 weeks of Cristiano Ronaldo's salary. I mean, that is a ridiculous situation that we find ourselves in. But with this inventory cover being so low, what does it mean? Well, first of all, visible inventory isn't total inventory. We do know that consumers are holding more on their own books these days. We also know there's a lot of material being held in warehouses that are, of course, not on the exchange. However, if you're a purchasing manager, what can you see every day? Only what's listed on the exchanges. And that's critically low. Plus, if you have a commodities futures position that you have to physically deliver against, good luck, because getting hold of material has never been harder in that regard. What does low inventory mean? A couple of things. Classic commodity economics, it means that if you're in a situation where demand maybe disappoints, maybe you do run a surplus, well, do you have to cut supply? Not until you rebuild inventory to normal levels. So actually, even if demand disappoints relative to what we might expect, there will be a lead-in to putting pressure on the supply side. So I think that it does mean that you end up, we don't need to trade into cost curves is basically what I'm saying. Certainly not at the current time. And with that, you end up with, again, that risk premium, as I call it. You do end up with a higher through-cycle price to look at, I mean, to basically adjust for the fact that you have such low inventory cover. So this is a very important thing. It could lead to a lot of volatility in some of these even exchange-traded metal prices this year. It's definitely something we'll be keeping a close eye on. Now, here we come. Let's come down to, I mean, it's actually been a decent cycle for metals and mining on the whole. Pretty good returns if you look at the EBITDA there. I mean, again, pretty close. In fact, 2022 may even have exceeded 2011's peak for global mining EBITDA. What's different is the lack of capex. What have the large miners been doing? Well, they've gone to shareholders and said, look, we will use our bulk commodity portfolio as a cash cow, and we will harvest that cash into paying you shareholders for owning us, and also for pivoting into future-facing commodities. We've seen a lot of the returns. We've seen not so much of the pivot yet, and I still think that pivot will have to come over the next little while. But quite honestly, if you're sitting on the board of a major diversified miner at the moment, you're being paid to say no to everything. And you've got good teams coming through with good opportunities, good assets, but you know environmental permitting will take longer, so your payback period goes out. You know you're in an inflationary environment, so your capital costs you have less certainty in. The economics maybe are a little bit more of a concern. And the big thing is, you know your shareholders are still going to reward you for not straining the balance sheet. How does this have to change? I think it'll be interesting. I think we're starting to see, I mean, of course, a bit of an M&A cycle coming through, but I would also say we're moving back towards more the 90s model of getting mines up and running, and that it will be joint ventures at the asset level in many cases, or indeed, I mean, as this conference talks to a lot, the junior level comes through and then the senior level will take them out at some point. But I do think we're moving back to, if you want to call it the Escondida or the Antamina approach of 3 or 4 companies in at the asset level, spread the risk across balance sheets, ideally get someone from outside the mining industry who can probably get a lower cost of capital to finance the project. And it's interesting, I mean, traditionally that would be a Japanese trading house. Of course, we are now looking at automakers potentially coming in a number of cases. So this is going to be a bit of a change over the coming years. Talk about China. In terms of it, we look at various areas, and you can see there, China had a very mixed year last year. A couple of things I wanted to point to here. Number one, I mean, not all China was bad, but the construction side definitely was. And I'll talk to that in the next slide. If you look at industrial metals demand, though, copper was actually pretty good. Why was that? A couple of reasons. Number one, scrap didn't come back. When you have you had a situation in China where truck drivers did not want to cross city or provincial borders, so therefore low volume material like scrap did not come back to market. There was more pull on the refined cathode. So I think that to me was actually quite interesting. We are looking at a slightly better year in 2023, but we're still looking at low single-digit growth numbers in many cases. Now, I do want to talk about Chinese property a little bit. Now, just to flag up, look at that left-hand chart there. Starts completions in the real estate side, and it's very important, I'm calling it real estate here. On that real estate side, it was terrible. We know the pressure that developers in China had been under for 2 or 3 years, and basically they ended up being totally hamstrung last year. Sales were down, land purchases were down, starts were down, completions were down. And they needed an offset, so we had the traditional Chinese offset, and the infrastructure spending went up. Still metals intensive spending, but yeah, that went higher. Now, I think that left-hand chart's quite interesting. I'm sorry for those, I mean, there's a lot of lines on these charts, but I mean, new starts in the real estate side totally diverge from rebar consumption. And a lot of the question is, well, why is that? And I suppose the other question is, why did commodity prices do so well when Chinese property was so weak? The answer is, overall Chinese construction was not as weak. Non-developer real estate was exceptionally strong. What is that? Schools, hospitals, social housing, factories. So China offset a weak residential real estate side with a lot of fiscal spending. Now that fiscal spending is probably still going to be there for this year. And the question now is, do we see that property side at least stabilize or maybe perhaps improve? Chinese metal demand in Chinese property will never be back to where it was in 2020. But it's still going to be it's still the most important sector for demand, and it's probably going to just hover along over the coming years, rather than the aggressive overbuild you could argue we saw in the decade previously. Where China is leading the way is energy transition. You look there, we saw another record year for renewable capacity added. The target from the NEA in China, and who look after capacity additions, is 160 gigawatt of wind and solar additions. So we're still going to see China lead the way in energy transition spending. Of course, EV sales in China up 96% year on year last year, taking a bigger share of what was effectively a stagnant auto market. And there's a lot of, I mean, we can discuss it. Obviously, the central EV subsidy has been pulled for this year. Bit of weak data points coming into year end, but we're still, of course, looking at growth over the coming years. And talking about that China growth, I mean, I've just popped on there what the renewable energy targets additions are by 2025, and I've done it by country and Chinese province. And there's a reason for that, because if I put China as a whole, it'll be way off the top of the chart. 874 gigawatts of renewable additions, and of course, to remind everyone, renewable energy is more metals intensive than legacy fossil fuel generation capacity. And this is an important part of the fuel to material transition. The Gobi Desert alone, by 2030, looking at installing 450 gigawatts of wind and solar. These are huge numbers, and of course, will be very metals intensive. And the one thing we've always liked about China in terms of commodity markets, long-term planning, let's analysts like myself have a bit of confidence in that medium-term forecast. Which brings us on to, I suppose, an emerging topic in many of these markets. And of everything that's happened in the last year, the one thing it's done is accelerate what are called here geopolitical segmentation. Back when I started doing commodity analysis, back in the old days, there was Western world and Eastern bloc models. I'm not saying we're going back to that, and I really very much hope we don't. But the process is kind of, there's a lot of similarities. And what you have now with the Inflation Reduction Act, the European Critical Minerals Act, there will be a lot of support for, capacity additions in many cases. Whether they support extraction is another question, but it does mean, geographies like Africa will be absolutely crucial there. That left-hand chart just shows, effectively I put China and Russia on there in terms of share of commodity supply and the developed world, and you can see there's a big light blue segment in the middle, which is basically the battleground. And there will be a lot of wooing of economies to try and set up value chains over the coming years, and it will lead to a thing. Now, the second order impact of that is that we're moving in towards prime and subprime markets, as I would think about it. You end up with your prime commodity market, which is a value chain that you can verify, you can audit, you can have a bit of confidence in, probably at the lower carbon end of the carbon curve, and then you get those who can't, won't, don't qualify for that. and they will end up with a discount to the official market prices. It's very hard to get a consumer to pay a premium, but it is easier to get a consumer to pay for best practice sourcing. I'm remembering that. The example I put up there is the copper mark. Because ESG standards are still all over the place for the industry, we are seeing the industry start to look after itself, and the copper mark was set up, of course, by a lot of the copper producers to say, look, this can give you, consumer, a bit more confidence. We do see these sort of things getting more relevance over the coming period. A couple of other things to talk about before I take questions. In terms of stability and supply of raw material, it's not just a developed world problem. China has the same issue. I mean, and what I put up on the right-hand side there is, look, where does China get its raw material from? There's a lot of key dependencies there. I mean, in terms of cobalt from the DRC, these days, well, nickel ore from the Philippines, chrome from South Africa. So there's a lot of very concentrated supply risk there in a world that's got some geopolitical issues. What's China's strategy? The State Minerals Group was set up last year, and that's an interesting development. They are funded. They're getting a lot of backing from the Chinese banks. Of course, iron ore is where we're seeing the first movements, a lot of data gathering going on the iron ore side, and it is, again, about security of supply. We probably will end up with the China's State Minerals Group setting ranges potentially for materials. Now, whether they are adhered to or not, hard to know. But iron ore will be first, and then we might see things like nickel ore, bauxite, lithium even, being placed under the control of the State Minerals Group. No one knows how this will play out, but it does mean you effectively have strategic buyers coming through, which can exacerbate things in a low inventory situation in many cases. In terms of this dependence on China, I probably presented this slide to you before, but it just looks at that dark blue squares are China's share of refined metal production across what the World Bank classifies as critical minerals. And you see there is a heavy dependence there. That is why we're seeing all this support from developed world governments to set up alternate chains. They will need raw material supply for that. What it also means is that from an equity point of view, you will get different multiples for being in a friendly country, if you want to put it that way, versus one where you can't verify that value chain in the same way. And I think that's starting to come to the equity markets a lot more now. Energy transition demand still going to be a key growth area in many cases. It is the biggest positive demand delta. But what I would like to say here is that it is still a nascent industry in terms of a lot of this energy transition. In mining, we're used to things growing at low single digit. We use steel for the same things we used steel for 100 years ago. We use copper for the same things. In those type of commodities, we've got a good degree of certainty as to what the outcomes might be. Such a wide range of outcomes on a lot of this energy transition stuff. I mean, the example there is, of course, the one that everyone focuses on is EV cathode chemistry. I actually looked at what our, even just a 2017 cathode chemistry breakdown was. The one thing I will say to you, there was only like 4 bars on that. You look now, I mean, there's 11, there could potentially be a lot more. It's a complex thing. It's a nascent market. There's a lot of groupthink. There's a lot of linear forecasting. There's just a wide range of outcomes. Now, that makes it a little bit harder for funding to, and that lack of certainty makes it a little bit harder sometimes to get funding across the line. So I think the model is starting to change a little bit around how you finance and such resources. But it is a wide range of outcomes, and there's going to be a lot of changing in the way that these market dynamics go on. But that's fine. It's a high growth area. So therefore, you should be compensated for it in different equity multiples. But you look at energy transition demand delta, I mean, the numbers are huge. The question is, of course, how do we keep up with that, or can we? Some cases we can't. I mean, what frustrates me as an analyst is when I see some of my peers put up things like copper supply-demand balances that you end up with negative inventory. Negative inventory can't happen. You have to be a bit smarter. You have to think about how things actually solve. Commodity markets will always self-solve. And the way you do it, if you can't get enough resource out the ground, and quite frankly, in things like the copper market, we're not going to be able to do that, you have to start substituting. Substitution is a necessary evil. So it's interesting. Incentive pricing works when you have enough, you're not supply constrained. If you are supply constrained for the foreseeable future, you have to start looking at substitution pricing. So copper, we will substitute for aluminium in a number of areas, particularly the subcritical circuits, so low to medium voltage lighting circuits. This is a necessary evil, but it means that the copper price has to be at a level to convince someone to substitute on any given day. I mean, I use a 3.5 times copper to aluminium price ratio, so basically, that is higher than my incentive price analysis would be. So I've actually moved up the long-term price to try and adjust for that. So substitution is not a bad thing. It's a necessary thing. But I think we're at the point now where even if we're getting a lot of capital put into some of these industries now, you won't actually get the resource and time. Maximising out scrap, even then, we'll still have to substitute. It could be in the battery side that we maybe stop making batteries bigger for the sake of making them bigger. That's quite an inefficient use of raw materials. So again, it just, as I say, it raises, there's a wide range of outcomes that can come from this, but we are now looking at a point where, sadly, we're not getting enough mine supply in many cases, and substitution will have to come through to ration the available supply. Now, I mentioned scrap. Obviously, I mean, it is the real growth area in many of these markets, and it also plays into so many of the themes we've talked about. Suddenly, the developed world has worked out that scrap is the low-carbon resource that they are naturally long of and have a lot of influence in. So it's interesting, you're seeing the acts going through European Commission at the moment to basically ban scrap exports to non-OECD countries. You'll start to see a lot of the primary capacity that was maybe shut down in the past few years potentially come back as secondary capacity to process scrap. So actually, the scrap is becoming hugely strategic. We may well see it trade at a smaller discount to refined metal prices than we've seen in the past. But controlling that material through the cycles will be very interesting. A lot of OEMs out there are under pressure to own their Scope 3 emissions. What it moves towards is effectively a leasing model. Now, whether that's done at a company level or a government level, it's hard to know. But I do think there'll be a lot of focus on maximising that resource. It's actually good for metals demand on the whole, but of course it does mean the more scrap we get back, the little bit, all other things being equal, the little bit less virgin mine supply we'll need. So it's complementary to mine supply. We will need them both, but it is the one that I think strategically you will see recycling rates move up. There'll be a lot more push for circular economy behaviour. I say it's actually a re-rating thing for metals and mining as a whole, because if you think of the global energy financing we see at the moment, it is based on the fossil fuel model, which is a use-up model, whereas metals you can use again. So you may find that financing rates change a little bit, because you're looking at value material through the entire life cycle, or 2, 3, or 4 life cycles. A couple of things to watch for in my final slide is just around the return of investors I mentioned at the start. I've just used gold there as an example. Well, we saw a big outflow from the gold ETFs last year. Again, with the dollar strengthening, there was no reason for investors to macro asset allocators to push too hard. And I do think macro asset allocators, by the way, are the key setters of the gold price at any point in time. So you've seen them kind of stabilize, and now I think you might start to see some inflows come through again over the course of this year. The second thing, in particular from an equity perspective, is do we start to see costs go down a bit? We'd be of the view that labour costs will probably still rise in a lot of areas. Very interesting to see, particularly some of the US companies report their Q4 results. Some of them are saying, look, we basically can't get anyone. We can pay them, we can pay anything, but we can't get people to work at our mines. So that is going to be an ongoing challenge. But clearly, with oil prices down, with some of the other goods elements of inflation coming lower, we would be expecting to see all-in sustaining costs in many cases drop this year, which actually reverses the trend we've seen in recent times. I'll leave this up there while I open up for questions. It's like, again, I've said to many of you before, every analyst likes to put everything on one chart. The x-axis here is the potential for a long-term shortage, and you can see there, look, in many of these cases, I'm looking at demand adjustment being required to balance the books, and the y-axis is more the short-term constraint. I mean, how tight are we right here and now? Thermal coal, for example, super tight at the moment. Longer term, still a bit of a sunset industry. Thank you very much for listening, and I think I've got time for a couple of minutes of questions.
Yeah, thank you. Great presentation. You just made a comment about the outflow on the gold ETFs, and you said that's quite logic. But how can you, if you compare that with the record demand from central banks, highest in 55 years, so that doesn't add up.
So it's interesting. So if you look at those, that's physical backed investor ETFs. So investors were out of gold last year. So you got 3 elements of gold that you always have to balance from the demand side. You've got central bank demand, which we view as a bit of an annuity, but we did definitely take a big step up last year, and that will probably continue as many of these countries want to de-dollarize. It's almost a function of that geopolitical segmentation I talked about before. There's the retail demand. Now, you could argue, I mean, it was just a bit of cryptocurrency, but we had really strong retail demand last year, so the traditional gold buyers came back. But on a day-to-day basis, the reason I look at those gold ETF holdings is I view a macro asset allocator as your marginal buyer or seller of gold on any given day now. They're the ones who can move really move things. They were investing in other things now. Their holdings have actually become more of a function of general assets under management. There's a lot. Gold always used to be inversely correlated to other things. Actually, because you've got so much money managed at this macro asset allocation level now, becomes a function of, I mean, it becomes much more correlated with general holdings.
So who's the smarter investor, the central banker or the institutional investor?
Well, the central banker can take a longer term view and take a more strategic view. All have their own reasons and their own things. I mean, what you've tended to see is a lot more, I mean, sadly, a lot more short-term focus. I mean, at the end of the day, even your long-only institutional investors get judged on a one-year performance.
But isn't it telling that when your business model is printing money and then you start buying gold, that tells a lot?
Yes.
Thank you.
Thanks for the presentation. I thought it was really good, first of all. Just really asking for your prediction on the copper price for the for 23 and perhaps into 24.
Sure. In fact, 23 and 24 were meant to be bad years for copper. We were meant to have enough supply. The surpluses, which I mean, I saw people put surpluses up of 700,000 for this year. They're gone. I mean, we're effectively in a balanced market. Now, I would say copper at, well, it was until late last week, $9,000 a ton. That was pricing in China perfection again. And then to the point I made right at the start, I have a little bit concerned that China will be a little bit slower to step up. I mean, if we have copper in that, $8,000 a ton, I think is a good level. I think I'm slightly higher than that on average for this year. Now, the longer term, the 2025 onwards, I think everyone agrees that we are going to have to go to substitution pricing. The one thing I would say in copper this year, I don't think we're mine supply constrained. I actually have a problem with smelting capacity. I don't think we have enough smelting capacity. So, therefore, we don't need the copper price to go down at any point. Even if we run out of space for concentrate storage, then we would actually, you'd have to see the TC go up rather than the copper price come down in order to push supply offline. Just one more thing, and I know I'm out of time, is that obviously we're looking at disruptions in copper. I mean, with the situation we have in Peru at the moment, clearly there is a bit of a risk there that the disruption allowance will come in higher than many analyst expectations. Thank you very much, everyone.
Thank you. Thank you very much, Colin.